If it isn't one thing, it's another. Doves looking for reasons why the Federal Reserve won't hike rates next month have neatly slotted Chinese devaluation into the gap left by the resolution of the Greek crisis. Assume the continuation of the two-day drop in the value of the renminbi against the dollar, as well as the knock-on effects on Asian currencies, and the region will be exporting so much deflation that no sensible central bank could tighten policy. On the other hand, treated at face value as a modest realignment of the exchange rate, which is an interpretation made somewhat easier by Chinese intervention today to prop up its currency after the falls proved too large for officials to stomach, and then the dovish story is less convincing. Still, there are two distinct ways to look at US monetary policy. One is through the lens of the flow of economic data. Seen this way, there's little reason for the Fed to act. Inflation remains below the 2% target, and both Asian currency weakness and the renewed tumble in oil and commodity prices of the past 6 weeks means there's likely to be more downward pressure on prices. Earlier this year, there were indications that wage rises were on the way, but at least so far, pay hasn't taken off. Even with unemployment at just 5.3%, the lowest in 7 years, many economists think that it can still continue to fall further without labour shortages appearing. Now, as usual, markets are extrapolating short-term price pressures into long-term inflation expectations, with China's shift accelerating a downward trend that was already underway around the world. These lines here show the market's expected inflation rate for the 5 years starting in 5 years' time, when the effects of the latest shifts in oil or commodities really ought to be long past. You can see the US coming down really quite fast, Eurozone particularly fast there with the Chinese effects thanks to Eurozone exports, and the UK coming down rather less. It's worth noting the UK here is calculated on RPI, so if it was calculated on CPI, as these two are, that would be rather lower. Now, traders had been moving away from this view of how the Fed would react, but thanks to China, the doves have returned. The odds of a September Fed hike priced into futures markets have dropped from 60% on Friday to about 40% now, and bond yields have come down in line. You can see on this chart how the rate-sensitive 2-year bond yield has suddenly fallen back in the last couple of days there. Now look at the US instead from the point of view of someone who'd been away for a decade, and the story's quite different. Interest rates are at zero in an economy which is growing at a reasonable, if not spectacular rate, and has little spare capacity left. Any basic model suggests that rates should be far higher, even without signs of serious inflation. The Taylor rule that's beloved by radical Republicans, for example, suggests that to justify current rates needs an assumption that unemployment could fall to 3.5% before triggering inflation, as well as assuming that what's known as the neutral real interest rate is a very, very low 1%, which is far below economists' usual guesses. Now, add in the advantages for the Fed of buying itself space to cut rates in future if something goes wrong, and it makes sense for the Fed to go ahead with a rate hike next month. After all, is the US economy really so weak that it can't withstand interest rates at what would still be a historic low of 0.5%?